Well, take a look. We want to continue to follow what's happening on Wall Street as we approach the midpoint of trading for this Tuesday. We've seen some wild swings, haven't we? Just the first few minutes of trading this morning. Oh, heck, why start there? Let's go back like yesterday. Down 1,600. Down 1,100 at close.
Why are you living in the past?
I know. When we were open, just paltry off 350 points this morning, and then we jumped up. So it's a little hard to keep track of all of this. And so we called Dave Wentley in, one of our financial experts, to try to sort through some of this with us. How's your stomach?
Oh, it's been better, but it's fine. It's fine.
Is it? I mean, why all the wild swings? I mean, now we're down 36.
Right.
A couple hours ago, after being off 350, we jumped up more than 100 points. And now we've been off. What's triggering all this?
We've been lulled to almost a sleep for the last year or so with volatility. And what we've seen the last couple of days is that we finally figured out the market has moved too far, too fast, particularly in the month of January. So what you're seeing is the market correcting itself. It's not the end of the world. It's actually a very short-term event.
To just that point, wasn't it just 8 days ago we had a record high?
Yes, yeah. And that's when it pulled back, because markets always overshoot to the upside. They often will overshoot to the downside, and then they try to figure out where they belong. And that's probably what they're doing now. What's changed? Fundamentally, nothing has changed. The economy is strong and getting stronger. Corporate earnings are as good as I've seen in probably the last 15 years. And not just here, but around the world. So what you're looking at specifically is a trading event, a very short-term momentum trading event. And if you're a long-term investor, and everybody should be, this will pass.
So if you're in your 20s and just starting with your 401k, what do you do?
Fund it. This is an opportunity. You were talking about record highs 2 weeks ago when your paycheck went and you were buying fewer shares at a higher cost. Now that those same investments are lower, you're buying more shares at a lower cost. That's dollar cost averaging. That's how you really make money over time in the stock market.
Late 30s to what, mid 50s?
Same thing, like clockwork. Don't even look at this. There's other things going on in your life that are far more important. You probably won't even remember the year this happened.
Late 50s to 70s.
Late 50s to 70s, you should already have a pretty good understanding of when you're going to retire if you're in your late 50s. If you're in your 70s and you are retired, your plan should be in place where you already have money set aside safely that you're going to need in the coming days, months, and perhaps years.
So what I'm getting from you as we drop now to below 100 points, we're off 100 right now as we come up to the noon hour, is that really no matter where you are in age, you basically don't do anything.
Not on a day like this.
Unless you can put a little more into your 401k in your 20s and buy more.
Here's the problem. You get out today, when are you going to go back in? The best time to go back in the market is when you are so scared that you're never going to go in the market again. Nobody ever does it. So any bounce back you're going to miss. Stay the course, own quality investments, and keep a long-term perspective, and you'll be fine.
And there's nothing wrong with this type of a correction of sorts?
No, this is routine. It's just that it happened so furiously and so fast, it caught everybody off guard. And I can say a 16-point intraday drop yesterday certainly got the attention of a lot of seasoned people.
Oh, it sure did. All right, so in other words, stay buckled up, but
ride
it out.
Yeah, absolutely.
Keep driving forward.
Ride it out.
All right, thank you so much for the
My
insight,
pleasure.
Dave.